does an 18% annual return on your money sound? If you'd invested in emerging market bonds last year, that's what you would have made. But this year is a different story. Returns on emerging market bonds have been nearly flat as of early March, according to Morningstar. At 4.2%, yields on emerging market bonds still trump yields on U.S. Treasuries. But yields are at record lows as investors have bid up the securities. So are emerging market bonds a risky bet, or are there still opportunities? Here to weigh in is Kristin Ceva, Director of Global Government Debt Strategies for Payden Rygel, a Los Angeles-based investment firm. She manages the Payden Emerging Markets Bond Fund, which is up 13% over the past year, compared with 10% for other emerging market bond funds. Kristin, welcome to the program. Thanks so much for joining me.
Thank you.
So what do you say? Are there still opportunities in emerging market bonds now, or are they too expensive?
There are definitely, in our opinion, opportunities out there in emerging market bonds. The whole emerging market sector has really expanded and broadened. So the yield that you quoted overall on the index, there's a lot of opportunities in emerging market local bonds and emerging market corporate bonds, which we're using actively in our portfolios to bring up that yield to between 6 and 7%. So definitely pockets of opportunity out there in that broadly expanding universe.
We saw last year that the dollar-denominated bonds seemed to run more perhaps than the local currency bonds, which did run up, but not as much. Are you finding greater opportunity in the dollar-denominated or the local currency bonds?
Well, it really depends on the country. There are certain countries, particularly the higher quality investment grade dollar pay bonds, that we think have gotten a bit rich. And in some of those countries, we are rotating into local bonds and also into corporate bonds, where you're picking up a yield spread over what you're getting in the sovereign dollar pay.
To drill down a little bit further, in which countries are you finding the greatest value now? I was looking in your portfolio. It seems like you're pretty heavily invested in Latin America. Is that right?
That's right. We see a lot of opportunities in Latin America and in countries like Mexico, for example, where we're expecting a lot of reform momentum under the new president. We see opportunities across the board, but particularly in the local pay and also in some corporates. In countries like Peru, one of the fastest growing countries in Latin America, we see opportunities there in certain corporate bonds, which really take advantage of the expanding middle class, for example. So we see a lot of different opportunities, both in the sovereign and the corporate space in Latin America.
Now, I understand that you are launching a emerging market corporate bond fund, right, at Payden. So I wonder, is that to sort of speak to the point that perhaps there are more opportunities in corporate bonds in emerging markets than perhaps we've seen in the past?
Absolutely. 2/3 of the issuance that we saw in the dollar pay space last year was in corporate bonds. 1/3 was in sovereign bonds. So there's definitely a lot more opportunities to choose from, a wider set of companies that we can look at in this space. And also the demand for emerging market companies has increased across a wider investor base, as many pension funds and endowments and so forth are looking to broaden their exposure to emerging markets and take advantage of new opportunities.
On the local currency bonds, I wonder, how difficult is it to pick local currencies in this environment? Are investors taking on greater risk with local currency bonds more so now than in the past, given that nations around the world are undertaking quantitative easing, and whether that's deliberate or not, it is devaluing their currencies, and emerging markets may respond to that, right?
Well, certainly there are risks of volatility in the short term surrounding any sort of currency exposure that you may be taking away from the US dollar. But our view is that although you'll have short-term volatility surrounding QE or quantitative easing that's being done by various central banks around the world, or some of the volatility that we've seen around the euro and whether or not the euro will hold up, these things do affect emerging markets currencies. But we feel that over the long term, the fundamentals will really win out. And because emerging market currencies are growing at a faster pace than the developed markets, and because these emerging markets are receiving more foreign direct investment and so forth, we feel that those fundamental pulls are really what is going to win out in the long term in terms of emerging market currency appreciation versus developed market currencies.
Kristin, thanks so much for your insight and for coming on the program. I so appreciate it and hope to speak with you again soon.
Thanks so much. I enjoyed it.
Kristin Ceva, Senior Portfolio Manager and Director of Global Government Debt Strategies for Payden Rygel.